Welcome to JStock Radio Deep Dive Analysis.
A quick heads up, this content is for educational purposes only and is not financial advice. Investing involves risk, so always do your own research.
All right, so today we are pulling the curtain back on a true hidden gem, one that's focused on the literal foundation of Japan infrastructure.
We're diving into Daiichi Kensetsu, ticker 1799.
And this is a name that just, flies under the radar. It was founded way back in 1942, starting out as a railway construction specialist.
Right, and they're headquartered up in Niigata, but their operations are really all over northern Japan. We're talking Tokyo, Nagano, Akita, Sendai.
So they're right in the heart of where Japan's largest railway operator works.
Exactly. And that specialization, that's the first key to understanding their moat here. This isn't just a generic commercial construction.
No, not at all.
They specialize in that essential high barrier to entry infrastructure work. So railway track and line work, bridge replacement, seismic reinforcement.
The really critical stuff.
The stuff that has to get done no matter what the economy is doing. Disaster prevention, recovery work, it's a constant need.
And this just feeds directly into that huge Japan macro story we keep talking about, right? This aging infrastructure that needs constant renewal.
It does. And what really seals the deal is their deep relationship with East Japan Railway Company, JR East.
Okay, yeah. In late 2022, they became an equity method affiliate. So for a global investor listening, what does that actually mean?
It means they've basically locked in a perpetual high-quality client. I mean, JR East has a massive footprint.
A huge footprint.
And by becoming an affiliate, Daiichi Kensetsu is effectively plugged into JR East's long-term capital spending plans. It's almost a guaranteed revenue stream for critical work.
And you can see that institutional demand showing up in the numbers. Looking at the first half of the 2026 fiscal year, the operating leverage is just wow.
It's fantastic.
Revenue was up a solid 5.7%, which is good, but the operating profit surged 17.2%.
And that drove net profit up by nearly 25%. That whole jump came from their core construction segment.
The profit momentum is great, but here's what gets me excited. The forward visibility.
Oh, this is the real kicker. Total orders received jumped an incredible 46.4%.
Almost 50%.
And their carry-forward construction work is now up over 60%. They have like 2 years of work already lined up, especially in architecture, where carry-forward nearly doubled.
Okay, so the fundamentals are rock solid. But let's talk about the big catalyst everyone's watching. TSE Reform. Why is this small cap a prime target?
It's the textbook case. It really is. Its market cap is around 74 billion yen, but its price-to-book ratio is only 0.89x.
So it's trading below book value.
Exactly. The Tokyo Stock Exchange is breathing down the necks of companies like this. They're basically saying, improve your capital efficiency or else.
And the market is valuing this company for less than it's worth if they just liquidated everything, despite sitting on a fortress balance sheet.
A fortress is the right word. Their equity ratio is a staggering 87.3%.
And get this, zero interest-bearing debt.
Zero. That kind of discipline, with a PB under 1, it's a mandatory look for any institution tracking the reform play.
And they're not just sitting on that cash, they're rewarding shareholders.
Right. They're forecasting a stable 130 yen dividend, and their track record is amazing. 8 dividend increases, 0 cuts. Plus, they were actively buying back shares.
Now, here's where the growth believer in me gets really excited. They're tackling the biggest macro headwind in Japan, the labor shortage.
With technology, which is the key.
Yes. Their R&D isn't just, window dressing. They are pioneering self-flying drones to move heavy materials across rough, mountainous terrain.
Which is a huge deal. That moves complex logistics from days of hard manual labor down to just a few hours of automated work.
It's incredible.
It is. They're applying tech directly to a shrinking labor pool to boost productivity, and we also see their proprietary tech, like the D-flip method. It's a specialized, patented technique for handling track components on really difficult inclines. It gives them a real advantage over the competition.
And that commitment to their people, their talent, shows up in their ESG strategy too. They were recognized as a Kenko Investment for Health Corporation.
Which is more important than it sounds. Retaining these highly skilled engineers isn't just about salary anymore. It's about well-being, and that's critical for labor retention in Japan's construction sector.
So when you put it all together, the non-replicable moat, the huge backlog, the zero debt balance sheet, making it a perfect TSE Reform candidate.
And their strategy to future-proof their labor model with tech, This small cap is a highly compelling strong buy candidate.
The long-term compounding effect here is just. It's a niche expert that's using technology to beat the macro challenges of an aging economy, all while keeping unbelievable financial discipline. That's the real story you should be paying attention to.
Keep hunting for value, and see you in the next deep dive.
Keep hunting for value, and see you in the next deep dive.